And we're live. Hello, everybody, and welcome to another episode of This Week in Real Estate, hosted by yours truly. My name is Ray. I am a bearded man of real estate. And we're live on YouTube, Facebook, Instagram, LinkedIn, Kick, Twitch, and we're live on Clubhouse. So thanks, everyone, for joining. If you're joining us live, you can comment, and I can display your comment and talk about you just like Matt Lamarche did. He's first again. He's back on top. Olivier, probably buried in the snow. Yeah, that Trump AI. I'm going to show you guys the thumbnail. I definitely used AI for the thumbnail today. And I made myself, you know, the Kid Rock, for those of you audio listeners. You remember when Kid Rock was in the America suit, standing by Trump, signing something for the music industry? I put myself in that outfit and put myself by Trump, signing the 50-year mortgage. We're going to talk about that today. Is it worth it? Is it not worth it? We're talking about Zillow's new lawsuit. Yes, they're getting sued again. So thanks, everyone, for joining. This is episode 340 of This Week in Real Estate. That's a lot of weeks to be doing this show. Do the math. So we knew what we're talking about. We're professionals. And I'm super excited because so far it looks like everyone can hear me on all the streams and stuff. What's up, Frosty? Mia, she said, did you hear Glenda's live? I didn't hear the live, but I do have a clip from Glenda that we're going to play today. I shot her a text and asked her if we could play it. We're gonna talk about it, about the Zillow thing. What's up, Kimberly Mann? She said, good morning, Ray, over there on Instagram. Frosty is in the house from Houston. All right, everyone. So thanks for joining. We do have a lot to talk about today. A lot of it is economic news. We have a couple of industry stories, some industry tea that we're going to dive into today, too. So thanks, everyone, for joining. Hillary Kerchief of Nashville says, go Merca. Yeah. 15-year car loans? Really? I didn't know that was a thing. Matt Lamarche said, I'm getting a new Porsche. Is it a new Porsche or a new Porsche? He doesn't have audio, so he can't tell me. The lady that I know that worked at the Porsche dealer calls it a Porsche. But that felt wrong when I said it, because I grew up calling it a Porsche. Okay. On to more important things. Let's do a little bit of background. Let's see if we like it this week. I think last week it was on number 13. Was where everyone could hear it and they enjoyed it. So let's just let it sit. Let's see if it works out. If it doesn't work out, we'll change it. Maybe I'll do lo-fi next week. That way it's more of like a lo-fi feel. But all right. So first up on the docket, Zillow hit with another lawsuit. And I can't tell if this was a separate lawsuit or if this was part of the same lawsuit. Oh, man. So sorry. When I even have it set to where no one can disturb me, but if someone calls me like 4 or 5 times, it pushes them through anyway. So I don't know. So sorry if you got the call. All right. I can't tell if this is a new lawsuit or if this is the same lawsuit, part of the lawsuit that we covered already. But this is new news. So I'm assuming it's new. Zillow hit with a new class action lawsuit over alleged broker kickbacks. So this suit alleges that a requirement for premier agents to meet pre-approved quotas on Zillow home loans as a condition for maintaining access to these high-level leads led to steering. So for those of you who don't know, maybe some consumers out there, Zillow's got a lot of products that they're trying to offer consumers. They are also a website built for real estate agents. Actually, it's built for them. It's built for their shareholders to make money off of real estate agents. And for years and years and years, real estate agents would buy a zip code. And we purchased the zip code and we would purchase a rank of that zip code. So you could purchase first place, second place, third place, or you could just buy it the whole zip code. And you would get all the leads or a portion of leads from that zip code. Well, it was working for a long time. As a matter of fact, I was spending some good money. I would give Zillow $1. They would give me $3. I mean, it was pretty good turn. And we were there to answer the questions for consumers because they would hit that Zillow button and get a rando. So I was happy to be the person that they got. And then I could convert them to hopefully working for me. with me. So Zillow said, hey, when someone hits that button, they actually think that they're talking to Zillow. So it is up to Zillow to make sure that we convert them and push them through to other services offered by Zillow. What are these services? Lending. I don't know if they have a title. I think they have a home warranty. I'm not sure if they have insurance. But the agents have something called .loop that they are using. There's also Showing Time Plus. And yeah, Mia Zoll said, whoever was faster to the lead. Yeah. And it wasn't the listing agent. You're absolutely correct. Mia Zoll says it was not the listing. They would hit the button that says contact agent. And Zillow said, oh, when they hit that button, they think they're contacting us. I think most sane people knew that they thought they were contacting the real estate agent that had the property listed. That's neither here nor there. So Zillow said, here's what we're going to do. We're tired of these leads just going to real estate agents who then convert those people and take them to their own local lender, who in many cases, the lender was paying for the lead as well. So we're tired of them just taking that lead over to their people. So what we're going to do is on the back end system, create a scoring system that allows us to see who is getting the most leads over back into the Zillow stuff. We will rate them higher and we will send more leads and better quality leads to that agent. What? Uh-oh. Olivier said Olivier got COVID and we got 8 inches of wet snow. Fun week. Oh, wow. There you go. All right. So let's read more about the suit. The mega real estate portal has become a target of another class action lawsuit, this time over alleged illegal kickbacks to brokers in the form of client leads in exchange for sending consumers to the company's financial arm for mortgages. The complaint was filed November 7th. Oh yeah, this is a new one. Let's see. The primary target of the lawsuit is Zillow's Premier Agent program. So the other lawsuit, I believe, is about the Flex program that takes 35 to 40% of the real estate agent's compensation, is not disclosing that to the consumer. Kimberly Mann over on Instagram, realtor_Kimberly_man with 2 N's, said, I had an agent tell me Monday that Zillow said that in order to keep getting leads, you have to kick back to Zillow Mortgage at a certain percentage. I said it's a bad sign for Zillow Mortgage. Yeah. Red Rocket Mortgage was also had a program like this. I don't know if it's still there. And I cannot remember if they're in trouble or not over it, but Rocket Mortgage was sending people to agents that they had on a list in which they were receiving kickbacks from as well. Referral fees. Sorry, they were receiving referral fees. Jasinski_Steve says, oh, Zillow, you crazy kids. Yeah. Yeah. We will see. We'll see where this stuff leads, but I don't think it's going to be a good outcome for Zillow in this specific lawsuit.
Hey, Ray, all the,
what's up, Andy?
I mean, Veterans United does this as well. They'll get the lead for the loan, and then they've got a real estate brokerage that they send it out to an agent that's signed up in their system.
Yep.
But I had a deal one time where I was like, hey, would you mind having your buyer pre-qual with a different lender because I don't trust Veterans United? And she said, no, I can't do that. I'm not allowed to do that.
Yeah, that's not good. I mean, these referral programs are going to go by the wayside. Back in the day, I remember when real estate agents were beloved and all the lenders and stuff would send us on trips. This is the opposite. This is the same thing happening, just the other direction. That's not going to go over. Ellis Home Inspections, LLC. What's up, Pat? Mr. Patrick Ellis. He says, this is how Angie's List works. One lead gets sent to 3 to 5 other, quote, contractors, and whoever reaches out first gets the client. That's old school Zillow. It was a few weeks ago until there was a Zillow lawsuit, finally back to normal. Yeah, I know, right? I didn't have a show last week, so we didn't even talk about a Zillow lawsuit for the first time in a long time. Yeah, I think, Andy, I think you're right. I think all these home loan referral agent group things, it's definitely going to be under the microscope. All right, so agents who meet the ZHL pre-approval quotas receive better leads and placement, while those who fail to do so face reduced volume or removal from the program. A textbook quid pro quo that turns Zillow's referral network into a mortgage funnel in which Zillow controls the flow of valuable buyer leads. The complaint continues. Zillow system harms consumers who got robbed of the disinterested advice of their fiduciary real estate agent and instead are unknowingly steered towards Zillow Home Loans limited and often uncompetitive mortgage products. Whoa. So a home buyer named Araba Araba Armstrong from Anchorage, Alaska. Wow, look at all the alliteration. This is a storybook lawsuit. Araba Armstrong from Anchorage, Alaska is serving as the lawsuit's lead plaintiff. They're connected to a premier agent in 2024. Oh, wow. It's still going on in 2024. The complaint alleges that it was pre-approved and ultimately secured a mortgage from Zillow Home Loans. Armstrong, who was the first-time home buyer, allegedly believed he was obligated to use Zillow for her mortgage. The complaint further alleges Zillow's is wielding a monopoly power to exert enormous pressure on real estate agents. It does feel like a lot of pressure out there. The complaint also states that the bright blue button on Zillow's listing says contact agent deeply directs buyers to a flex agent, deceptively directs buyers to a flex agent, not the listing agent. So in September, Zillow was also slapped with a class action lawsuit allegedly over deceptive flex agent tactics. Wow, my bad. Let me just take a breather. The suit claims that Zillow's inflated cost to home buyers through the Zillow Flex referral program, which imposes up to a 40% charge to agents who successfully close a transaction after a lead generated through the platform. It's either you have an increase in cost or you have a disincentivized real estate agent. It's got to be one of the two. It's got to be one of the two or both. All right, well, we'll see where this leads. I don't think Zillow has responded officially yet. And if you're like, is this really happening though? Is this an actual thing? Let me play for you. Let's see where to go. Oh, this is the banned version of the same article. Zillow accused of illegal mortgage kickbacks in the latest lawsuit. Let me find my girl. I thought I saved it. Maybe I did not. I want to play for you what my friend Glenda said about this. I could have sworn I saved the tab. All right, I'll just open a new tab. Because Glenda has an interesting perspective on it, and she also has a different take on Greg Schwartz than I have. So I have a more friendly memory of Greg Schwartz than she does. So, all right, let me pull this up and I'll play it for you guys. All right. Here she is. Share this tab instead. All right, here we go. We'll play a little bit of Glenda.
Well, good morning, ladies and gentlemen. My name is Glenda Baker, and I'm a real estate agent in Atlanta, Georgia. And today you're probably thinking, good God, her hair is big today.
Yeah,
my hair is big today. Yeah. I am headed into an event in literally just a moment. But I wanted to jump on here real quick, and I wanted to talk to you guys a little bit about the newest Zillow lawsuit that talks about that agents were scored, and if they sent more business to the Zillow partners, blah, 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 blah. Well, I talked about this on October the 1st, so this shouldn't really be a newsflash that it just came out. But But I wanted to chat with you guys a little bit because a lot of people don't realize, sorry, I have my contacts in and this was bothering me.
It's hilarious.
A lot of people don't realize I was actually one of the founding members of the Zillow Agent Advisory Board. I was one of the first agents here in Atlanta to buy zip codes.
That's how it used to go.
They used to sell it like you could buy 25% or 50% or 75% or 100%, and you would buy it. And we paid Zillow for leads for years and years and years. And I spent anywhere from $500 to $7,000 a month on Zillow leads. So I'm not pulling this out of my ass. I just want to make sure you guys understand that. And I might have spit just a little bit. Sorry about that. I'm, got to go fast, got to talk fast, and my mouth didn't used to go in this fast. But anyway, I was actually at a meeting on October 16th in 2018. And Greg Schwartz stood up in front of 200 real estate agents. And, our lead flow had changed. Those of us who were premier agents at that time, our lead flow changed. The number of leads had decreased significantly.
Yeah, just to clue you in, this is about the time where we noticed a huge drop. It was shortly thereafter, where we were getting 20 and 30 leads a month, and of those you pick up maybe 4 or 5. And we suddenly started getting 4 or 5 leads a month, and they're like, oh yeah, well, you can get one of those and still pay for it. It's like, no, man, this is no good anymore because I'm not getting what I was paying for. So this is the time that she's talking about.
And one agent stood up and said, hey, I'm paying you $25,000 a month and my leads have dropped by 70%. And he stood there and looked at her in her face. I'll never forget it as long as I live. He stood there at 1:16 p.m. He looked at her straight in her face and he said, keep your money. I've got $1 billion sitting in cash in a bank. I don't need your $25,000 if you don't like the way we're doing things.
Oh, I'm shocked that not everyone in that room just didn't walk out and say, okay, fine, we're all gone. We're done. But this is the strong arming using leads. You see, years ago, I was talking about this and telling agents, don't get used to the Zillow leads. You can't build a business on Zillow leads. If you build a business on it, they're going to start taking more and more and more and more and more. And now we have a Zillow Flex program that takes 40%. All right, let's keep listening.
That's what he said to her face, in front of 200 real estate agents from a stage. Yes, sir, he certainly did. So, and I don't know what his title was then, president, CEO, whatever he was at that time. But regardless, I digress.
This is interesting what it says on the slide.
They showed a slide at that meeting, and it showed about consumers think that they are, when they click contact agent, they actually think that they're contacting Zillow. That was what he said. That is what he said.
Absolutely
yes,
crazy.
That is what he said. I have the slide to prove it. And he said, because they think that, we want to give them an exemplary real estate experience. And the way we're going to do that is that we are going to provide consistent connections with agents that answer their phone. This was when they had the Zillow.
So that I have no problem about, right? You're analyzing agents that answer your phone. You're going to now provide a consistent connection with agents that are actually answering their phone. So scoring based on answering your phone, I am completely fine with. You should be sending people to people who actually answer the phone. That's totally fine.
Concierge, they came up with that. We're going to align with agents who provide elite service measured by consumer feedback.
Okay, so measuring elite service by consumer feedback, another thing that's totally fine.
On our CSAT scoring, CSAT scoring.
That's customer satisfaction.
We're going to streamline communication.
That means take over communications.
Around the transaction through software and service integration.
Okay, now we're getting into a place where they're measuring based on how the agent's doing and the services that they're integrating with that client.
Those are the exact words on the slide. Streamline communication around transactions through software and integration. So, ladies and gentlemen, if you think that Premier Agents didn't get business based on how much business they sent through ancillary services and software associated with Zillow, I don't know where you've been the last 10 years. Sit down, I'm not finished. Because the other thing on that slide says we're going to drive cost-effective buy and sell sides to Premier Agents who utilize this system.
There it is. I mean, it's right in their own documentation. That's called quid pro quo.
That is right. Yes. So trust me, there's absolutely a scoring mechanism built in to how you send business. Now,
all right, so go to Glenda Baker. It's Glenda with 2 N's, Glennda Baker, Baker, if you want to see the rest of that. But yeah, so I don't know what they would say. I mean, you can't say we weren't doing that because they gave this pitch all around the country. It's obvious they were doing that. And some of us were shouting from the rooftops a long time ago. That's not right. But I don't guess it matters.
Hey, Ray.
Yeah.
Have you seen any of the videos from is it Jared James, I think?
I know Jared James, but no, I haven't seen his videos talking about this.
Yeah, so I've seen several of his videos and like podcast clips and whatnot, where he's talking about the Premier agents, Zillow Premier agents, are messaging him on the back channel that they have like recorded conversation about all of this, where these Premier agents are talking to their rep at Zillow, and they're being told like, oh yeah, it says in the documentation that we only need 10%, but if you really want all those leads, we really need to be about 50%. So it's documented 10% in their agreement, but they're pushing them for more on the home loan side. So, and he says that these agents are recording the conversation, or they have the emails. They're actually putting some of these things in email. So there's all this documentation. Wow. Yeah, and if that is all true, even if it's just one, they're screwed. But if it's a bunch of them, they're way screwed. There's like that could shut down their mortgage business, and it may even hit main Zillow company's bottom line when it gets down to it. Because if it's coming from on top, then that's all going to be handled as well. And the feds will get involved in that in a heartbeat.
Very interesting. Let's share this tab instead. I think, let's see, this is from 21 hours ago.
Now, Zillow's in trouble when it comes to that whole thing.
So
because
we're going to see a big lawsuit coming.
It's coming, man. Like, if I showed you my DMs, the number of Zillow Flex team leaders and otherwise that have been messaging me, recordings of phone calls, actual emails that have been sent, what their reps are saying to them behind the scenes about the idea of steering, RESPA, all of this. It is insane. Look, even they sent me the booklets. They're telling you if you don't send this percentage, then we're not giving leads to you anymore. How is that allowed? And by the way, that percent they're saying when they're talking to their local reps, beyond that, the reps are saying something completely different. They're going, yeah, I know it says 10%. If you don't give me 50%, we're moving on.
Oh, shoot.
I'm not putting that on record. That's what they're saying over and over again. There's a lot of lawsuits going on right now. There's a lot of trouble coming down the pike for that stuff. And again, if you saw my DMs, I've never seen such anger. And now, because they're not giving over half their business or because they've referred other lenders and it's not Zillow Home Loans, their rep is like, all right, we're moving on to someone else. And they want them to keep sending it off to Zillow Home Loans, when many of these Zillow Home Loans are lenders. They're saying they're very young, inexperienced. They don't offer a lot of different financing. It doesn't work. They're like, the client decides. But now they're getting to a place where off the record, they're saying, oh, you got to at least send 10% to get an approval. But then their reps are telling them privately, no. If this many doesn't work with us, we're moving on. And it's happening now.
Wow.
So I'm telling you, man, there's lawsuits coming. I'm going to tell you.
Is that what you're talking about, Andy, I guess?
Oh yeah. That was the last. I actually saw that one this morning myself, but I've seen a couple over the last week or so from him that are basically the same thing. And he says he's been talking about it since October. So it is something that's been going around for a while.
Yeah, he said this was recorded October 14th. He said, who would like for me to do a live podcast with Glenda Baker about this topic this Friday? Yeah.
Right now, Zillow's in trouble.
There's also people in the comments saying that's completely out of context. I'm a Zillow Flex mega team leader, not pro Zillow or anti Zillow. Come on, man. If you're taking money from them, of course you're pro Zillow. Like, you can't say, oh, I'm not pro or anti Zillow. They only support 30% of my business, 20% of my business. Oh, come on, man. You're not. That's a ridiculous statement. I know who that is too. I'm not going to out him, but come on.
I mean, if nobody uses them, honestly, if no agent paid them, where would they really get their money from? You know?
Yeah. Yeah. I mean, that is their business model, is from real estate agents. So it would be cool. What a cool world it could be in the future, in which a future in which Zillow doesn't exist. Wouldn't that be kind of cool? I think that would be cool. It would be interesting. It's the most interesting thing that could happen, which Elon says. Usually the most interesting thing is the most likely. So let me see if I have any comments. Oh, I'm sorry. I'm missing some of the Instagram comments. Let me get back to you guys. Let's see. Kimberly Mann said, yes, you weren't allowed to move your Rocket leads to someone else, even if Rocket didn't close it. And she said the same true with Veterans United. Let's see. I work with relocation relo that takes 42% of your commission, and they don't let us say anything about that to the client. That's what Frosty says. Getting your own leads is harder, but ultimately better for your business. What Kimberly Mann. Let's see. I never buy leads from Zillow. Good, Matt LaMarche. Were they any part of the NAR lawsuit? No. Even though they are a brokerage, they were not part of the NAR lawsuit.
It should be now.
Yeah. What's up, John Taib? Wondering if Zillow is licensed to get paid on a real estate transaction. Yes, because they do have their brokerage license. Okay, cool. Sorry I missed some of those Instagram comments. All right, let's take a look at the next Zillow article. Believe it or not, they're still in the news. And this one, in my opinion, is just kind of weird how they're picking this fight with all this other stuff going on. Zillow's latest shot at Compass suggests anywhere agents will leave if acquisition takes place. This is from Broke Agent Media. Zillow just lobbed another headline in this ongoing feud with Compass. According to a new Zillow Group survey, 53% of anywhere real estate agents say they would or might consider leaving their brokerage if Compass's planned $1.6 billion acquisition of Anywhere goes through. I don't fully understand that. I feel like, there's going to be some people watching that are with a beloved Anywhere brand, and I want to know. I feel like Compass has better brand recognition and strength than a lot of the other brokerages that are with Anywhere. So why would an agent leave if Compass takes them over? I guess maybe if they were forced to change business models, or maybe they're afraid Compass is going to take more of their money. But if nothing else changes, if you could keep the model, but you had to change the brand, would you leave? If you didn't have to change your brand and you could keep your current model, but Compass was just the owner, would you leave? I have big follow-up questions with this Zillow Group survey.
Because I got a question about that. Like, some of these brands are older brands. They've been around. So I'm imagining you've got some very experienced agents that are probably saying, hey, if we change anything, I don't want to be a part of the change.
Yeah. I wonder how many just would retire. They're saying they're going to leave, but in actuality, they're just tired and they're gone anyway. Oh my goodness, Mia, I'm seeing your comment about Zillow. She said, you can't believe what Zillow did to a new listing. They put the old pictures in and the home has been totally remodeled and updated. I had that happen on one of ours. We had to get support to help us out on that. Just so you know. All right, here's what the Zillow survey found. 18% said they would definitely leave their brokerages in the next year if Compass acquires anywhere. 35% said they might consider leaving. 23% said the acquisition would have a negative impact on their business. Why? Where's that coming from? I don't get that. And I'm not a Compass guy. I'm at Real Brokerage. So I don't have a dog in the hunt, but I'm curious as to why Compass would have a negative impact. Maybe they're worried about the exclusive thing that Compass has going on and their listings not displaying on all of the websites. I don't know. Survey also delved into how agents at Anywhere feel about a private listing network. 70% said it's not in the seller's best interest. 55% said private networks benefit the brokerage or agent more than the sellers or buyers. 98% said the private listing networks would have at least one negative impact, such as reduced access to lower income buyers or potential fair housing concerns. So interesting. I guess, that of all the things, I think that's the only thing. I can't imagine someone saying, well, the Century 21 brand is way better than Compass. I can't imagine that being part of the discussion. In Century 21 with them or Century 21 with someone else? Maybe Century 21 is with someone else, but you get what I'm saying.
No, it is Century 21.
It is okay.
Yeah, they're under Anywhere.
All right, that's what I thought. I just don't know. Listen, I hope a lot of them leave and they come join me at Real. But I just don't. I don't see a reason to leave just because Compass takes it over, especially if they let you keep your brand and stuff, unless they're changing your money. If they're changing how much you have to pay them and such, I think that could be negative. Yeah, there it is. Cole Banker, Century 21, Corcoran, Sotheby's, and Not England Vulgars, Matt.
Can't be bought.
Can't be bought yet. Just wait till
only one dude has to make that call, but I with his name on the side of the building, I don't think he.
Hey, just wait, man. Gary Keller, he's gonna hop on that phone. Have y'all heard the rumor that this is totally rumor? I'm not even gonna have a news article up while I'm telling you this. Have y'all heard the rumor that Zillow is buying Keller Williams? I've seen this multiple times, and people are sending me DMs, and I'm asking for sources, and they're like, I don't have any, but it's happening. So, is it actually happening? Dusty says brokerage and brand fees. I don't know if they're changing all the brokerage and brand fees. Oh, there you go. I don't know if they're changing all the brokerage and brand fees on it, Dusty. I think they're going to let some of those, they're going to let a lot of them just sit there. Matt Lamar says, shocker, no differentiation and everywhere is a Compass agent.
Or anywhere, or
anywhere, everywhere.
Or underwear.
Underwear would be a funny spoof.
That's what we're going to start calling them.
Yeah. Anywhere is going under Compass. Underwear?
different spelling, but yeah.
Yeah.
With 340,000 agents, and I hope a lot of them do get out of the business, by the way.
Oh.
Because most Compass agents need a compass to navigate their way through a real estate transaction. But at least here in Atlanta, they've got, 400 or 500 agents. And a lot of those agents were bought. Like they had contracts and, move your business over here, whatever. But a lot of them in the next year are going to be, quote unquote, released from those contracts or have the ability to remove themselves from those contracts. I think that's actually going to be an more interesting thing because a lot of the Compass agents here in Atlanta have like really bought into the technology piece of things. They have spent $1 billion on it, I guess.
Yeah.
But the other ones, I don't know. I don't feel like they're going to I don't feel like they're going to acclimate.
So you don't think the dinosaur agents would have new life at Compass, basically?
I know, respectfully to all of these brands, I know that Sotheby's here in Atlanta is a very well-known name, very well-respected. But in other parts of the country, only through the power of Clubhouse have I discovered that Sotheby's is not as good in other areas. And obviously a lot of that comes down to local leadership.
Yeah.
You know, so on and so forth.
Disclaimer. We get it.
Correct. I'm not saying anything bad about any. I would never do that. But in other areas like Coldwell Banker is the cream of the crop. You know, I know like from Virginia, they're really good. But it will be interesting. Century 21 is also another one here in Atlanta that they don't have the greatest reputation. Their co-ops have been a bit of a challenge here recently. But a lot of that is just because of the number of transactions that they aren't doing. But yeah, I mean, if 90% of agents are doing basically nothing, I think we can afford for half of them to get out of the way.
That's true. You do have a really high percentage of agents just not doing a deal at all.
Yeah.
That's difficult to rationalize any kind of move anywhere, actually.
Also, I'd just like to be able to have a conversation with my clients that sounds something like, "Oh, you only know 3 real estate agents? That's awesome." Instead of 12?
Yeah.
Phenomenal.
Finally. You mean you can't just stick a sign in the yard right now and have massive success?
Shocker. It's funny how that works.
Well, speaking of multiple agents, let's talk about price fixing. New study calls out price fixing patterns among buyer agents post settlement. Wait. We've already had a lawsuit on this and it's all been fixed. It was all fixed. There was no price fixing, and the sellers are now saving gobs of money because all of the price pressure is now being put on the buyers, exactly where the sellers wanted it, right? According to the latest report from Consumer Policy Center, the home buyer experience contracts and commissions. The buyer agents are more likely to lower the commission for a seller who pushes back than for buyers they represent. Okay. Through the CPC lens, this is a red flag, but let's take a closer look. All right, so they had a bunch of mystery shoppers do interviews, 281 active buyer agents in 26 metro areas. During these phone interviews, the callers were posed with the callers posed as cash buyers planning to move in 2 months and to purchase homes somewhat above the area's median price. Each metro sample included agents from the most active brokerages and at least one from a different company. Most active brokerages. I would love to know if I'm in this and what I said. Based on those interviews, CPC's data points to differentiate how buyer agents handle commission negotiations with their buyer clients compared to sellers who request lower rates. This is despite more than a year of pressure following a landmark commission settlement. Yeah, you know what's happened? Let me explain this to everyone. As soon as the landmark commission settlement happened, all good agents raised their prices. Because for years, I've been telling buyers, this is how much you would have to pay me. And if the seller doesn't cover it, this is what you would cover. And for that, this is all of the stuff I do. I've been saying that for years. And I have had price compression because so many other buyer agents were saying, I'm free. Use me. I'm free. And because they kept saying I'm free and they wouldn't require their client to sign anything that obligated their client to pay them, then it was me offering real value at a real price that I was telling a buyer they would have to pay if the seller didn't, versus an agent saying, I'm free, use me. Now, that agent that used to say, I'm free, has to say, actually, you have to sign a contract. And in that contract, you're obligated to pay me. And if the seller doesn't pay me, you would have to. And what value does Mr. or Miss I'm free offer? Nothing. So I can say, wow, they finally have to actually charge. So I'm going to raise my price. And I think everyone who is any kind of good agent saw that opportunity and took it. Now, if you're in a situation in which the seller won't pay you, in some cases, the buyer is going to pay that fee. And it's going to look on paperwork like the agent reduced their compensation, but in reality, maybe they didn't. Maybe they're just getting paid by the buyer. Because my buyers like to pay me because we actually work for the money. We actually find them the ideal property. We actually door knock. We run ads for them. We find unlocked inventory, off-market properties, on-market, but it doesn't matter. We help them save thousands in negotiations and thousands in negotiations around the inspection. So our clients are really happy to pay us because we're worth it. But most agents are not. Because, you know, like Matt just said, if 90% of the agents aren't selling anything, then how worth it could they be? How experienced could they be in the negotiation? So when it comes down to it and the seller's like, I'm only paying you this much, that person's just going to take it. Like, fine. Okay. Now let's with that in our brains, let's read the rest of this. Agents push back hard on buyer negotiations. According to the report, most buyer agents resist any effort for buyers to negotiate commissions. Buyers who attempt to do so are often told it's unnecessary because sellers pay the buyer commission. See, this is what the old I'm free person, this is what they're saying now. Oh, the seller will pay it. The seller will pay it. While that may be the case, it's not a guarantee and shouldn't be represented as such. Others point to, quote, standard or usual rate for their market. Or worse, they argue that if sellers don't offer compensation, it could discourage buyer agents from showing the property. Well, that's just correct. I mean, that's, what do you mean, or worse? That is what happens. And we've already talked about this. You can't have it both ways. That, yeah, if it, just like a seller that says, I will pay all of your buyer's closing costs is probably going to get more buyer activity than a seller that says, I'm not going to pay any of your buyer's closing costs. You say that up front, you're just not going to get as many showings. That's normal. There's no different in that. And I'm Mr. Buyer. I'm going to make you come to the table with more money out of pocket. Do you want to go show my house now? Come on. Yet when it comes to sellers, the data tells a different story. 2/3 of agents said they'd be willing to accept a lower commission from the sellers if they requested it in the offer. Nearly 1/3 of that group would even accept at least 1 percentage point less from the seller. From the seller. Are they adjusting the compensation on the back end to the buyer? It doesn't say that. So yeah, I'll take whatever the seller wants to give me as long as my buyer is actually paying. Yeah, that's how it works. I don't understand the disconnect between this stuff with the consumer protection agencies and how real life real estate works. Stephen Brobeck, senior fellow at the Consumer Policy Center, states that this is why there hasn't been significant decline in agent commission with the NAR settlement. Our research reveals an important reason that commission rates have not declined in the settlement of the class action litigation that forced changes in real estate practices over a year ago. The settlement provided home buyers with new opportunities to negotiate commissions, but the industry has figured out how to minimize these opportunities. Or maybe it's that a lot of agents are providing value. Maybe. I don't know. Maybe consumers think it's worth it to have representation. Rates remain near uniform across markets. Despite the public scrutiny, rates haven't budged much. 95% of agents quoted rates between 2.5 and 3%. The few quoting below that range were primarily in the Boston area. Oh, that's interesting. Only one agent quoted above 3. Only one agent of the 280 something quoted above 3%. Interesting. The CPC compared this year's findings to a 2022 study. In that time, the share of agents quoting 3% commission rose from 40 to 64%. Based on that finding, the report speculates that some agents are treating the higher rate as a risk premium to offset potential losses when sellers demand lower payouts. I can see some people doing that. See, buyer contracts, another layer of complexity. When it comes to buyer broker agreements are now required under NAR settlement. The study found uneven compliance. A number of agents told the mystery shoppers that no contract was necessary before showings. Nearly half said they'd offer a short-term agreement or allow buyers to terminate without penalty. Many included clauses that allowed brokers to reassign clients to other agents. That's normal. A broker can assign any client to anyone. I don't know what that has to do with anything. Byron Nicole reviewed a litany of agent statements from the report. Byron called out a few in particular. This is from their broadcast. Let's see. If you're not in training, yeah, he's basically saying you shouldn't say these things. Several agents actually said on these phone interviews that they were charging the standard or usual rate in their area. That's bad. There is no usual. All right. According to the report, 27 agents said, quote, none of my buyers has ever paid a buyer agent commission. And 17 went further with, quote, the buyer won't ever pay. Wow. That's still basically saying they're free, but at least now they're having to try to explain themselves, which gives people like me an opportunity to actually provide value. All right, let me get some of your comments. I could see you. I could see you lighting it up over on YouTube. Matt Lamar said, "Yep, I have plenty pay it with no issue." Where's this article? This article is on Broke Agent Media. It's the only one I found about this article, actually. Let's see. Kimberly Mann said, all my sellers are not automatically offering buyer compensation. My sellers say, let them negotiate the offer. Yeah, that's what ours do too. The number of agents though, that I have, they're like, well, I don't want to show your property if your seller's not willing to pay compensation. And I have to explain to them, the seller is willing to pay compensation. You just have to put it in the offer, which is what we're all supposed to be doing. The number of agents that are like, well, I'm not going to show it then. Like, wow, that is how you get sued so fast.
Honest to God.
Yeah.
If I haven't had so many brokers say that in the last 60 days, the world would be a much better place.
Yeah.
Honest to God.
Yeah.
And it is not my job to explain that to you, by the way.
No, it's not.
As a cooperating broker.
I'm going to start putting out content though about it and tell all of my people here locally that if they choose the wrong agent, they're not going to see all the available inventory, because the number of listings that I've shown and got under contract with my client who told me up front the seller's not paying any buyer agent compensation. We go and we show the property. We get them a good deal on the property and they wind up paying my compensation. It's like you're leaving so much available inventory out there because you're taking what the agent says. But when it's put in an offer and the seller sees what they make and they see the net and they're like, okay, well, fine, we'll pay it. All right. Then why are you saying this up front? It's so stupid to say up front, I'm not paying any. Just say I'm willing to pay some. Just stick in the offer. We'll consider it with the offer.
The first and only offer that they had in 6 weeks on the market, and they say, no, we're not going to do that. But then they get the offer, and all of a sudden they're going to do
100%. Yeah, and I have agents say like, our seller's going to pay 1.5 on the compensation. And I'll say, it doesn't matter. And they're like, what? And I just say, it doesn't matter. Like, I have a buyer fee and the buyer is going to ask you to pay that fee. And if you don't pay the fee, we'll consider it. He's like, well, what is your buyer fee? I was like, you'll see it in the offer. I mean, it just doesn't matter. I don't really care what your seller says they're going to pay. I'm going to make an offer. And then if it's good enough and you want to only counter that one term, my clients are going to see that and it's going to take more money out of their pocket. And then they may feel differently about your listing.
So the only thing I'm saying is everything in real estate is negotiable.
Everything.
Hoping that they go, oh, okay.
Yeah. Lisa Blumgren says, we are listing buyers just like we list with sellers. 100%. Dusty says, I've never had a buyer blink twice at signing a buyer agent employment agreement. Not much has changed in how I already did business. Yeah, same with us. Move me to Bay Area. What's up over on Instagram? She says, nice. Yes, if it is all negotiable, just like it's supposed to be, then why are you offering anything up front? I mean, let's just stop. Just put in the offer. Everyone should have a different number on agent compensation with their buyer according to the value and the services that they offer those buyers. So if the buyer wants the seller to pay the buyer agent compensation, they can ask for it in the offer. Our buyers do. Everyone else's can do the same. It's not a big deal.
No, but see, we have to complicate it because our job is not that difficult. So we have to create false hurdles for ourselves to jump over and through, and then the flaming loop. I mean, good grief, man. This is why half of them need to get out. Just get out. I know you're considering another career right now anyway. And so, there is a shortage out there. We need AI bots. I think you can get $700 a week if you go and delete Yelp negative reviews. I mean, there's plenty of work out there.
I have an anonymous account. I just write negative reviews on all the other agents. I'm just kidding. I don't think you could do that. It's funny though. Hey, speaking of all-time lows, for sale by owners reach an all-time low. More sellers rely on agents. That's cool. For sale by owner transactions, better known as FSBOs, comprise of just 5% of homes sales in the past few years, beating out last year's lowest on record of 7%. According to the National Association of Realtors 2025 profile of home buyers and sellers. If you haven't got your copy, go check it out. Meanwhile, a record high of 91% of home sellers sold their home with the assistance of a real estate agent. Ta-da! Okay. You ready to talk about 50-year mortgages? What? And this is where the what's it called? Thumbnail comes from today. It's from the 50-year mortgage. And so for the audio listeners, it's a picture of me standing at the Oval Office with Donald J. Trump holding a executive order that looks like an executive order of a 50-year mortgage. I have like a surprised look on my face. I'm neither happy nor sad. It's just surprise. And Trump's happy about it. Super happy about this 50-year mortgage. So is this thing good or bad? I want you to drop in the comments. Is the 50-year mortgage a good thing or a bad thing? Let's dive in. In another attempt to make home buying more affordable, President Donald Trump floated the idea of a 50-year mortgage in a social media post. In response, Federal Housing Finance Agency Director Bill Plute, who oversees Fannie Mae and Freddie Mac, posted they're working on it and that it would be a complete game changer. All right, so how it might work. The real question, analysts say it is possible. The 50-year mortgage does not currently meet the definition of a qualified mortgage under Dodd-Frank Act, which provides investors with a backup from Fannie and Freddie if the loan goes bad. But regulators were given the authority to change that in order to ensure mortgage affordability. It could take up to a year to do. How it would impact rates. The average rate on a 15-year fixed mortgage is currently 66 basis points lower than the rate on a 30-year fixed. This would imply that the 50-year fixed would be higher. It all depends on investor demand for the product. You would think investor demand would be pretty high because the amount of principal that somebody's paying in on a 50-year note, especially over a short time period, is a lot. And we're going to look at the numbers in just a second. I actually had ChatGPT do some math for me. So, we'll look at the numbers as long as the math that ChatGPT did is indeed correct, which I think it is because I had it double checked. So let me bring this up. There you go. All right. So I've got ChatGPT over here. I'll come to that in a second. All right. So drop in the comments before I get it. Is it a good deal or a bad deal? Is it good for buyers? How it impacts affordability? Even realtors agree that savings on homeowners would be minimal. This is not the best way to solve housing affordability. The administration would do better to reserve tariff-induced inflation. That's what Joel Berner, senior economist at Realtor.com, said, but there really hasn't been that much tariff-induced inflation. Inflation is currently hovering around 2.2%, which is pretty low. And by the way, inflation hovering at 2.2%, people are like, oh, well, grocery prices are still high. Yes, but they are going up at a slower pace. That's what inflation is. You're not going to have negative inflation. That would be a bad situation. But prices are no longer going up at 9%, in which they were in the past 4 years. All right, so adoption of a 50-year mortgage product might complicate the path to privatization for Fannie Mae and Freddie Mac. That said, we understand the administration is expecting the GSE to remain under conservatorship after it sells roughly 5% stake to the public. All right. What's the math on it? Let me see if we've got it over here on Broke Agent Media. Plute, this is the Fannie Freddie guy. We hear you. We are laser focused on ensuring the American dream for young people, and that can only happen in the economic level of home buying. A 50-year mortgage is simply a potential weapon in a wide arsenal of solutions that we're developing right now. The alternative thumbnail that I thought about for this week was a picture of a 20-year-old and then a picture of a 70-year-old, same person. So you can visualize how long 50 years is. You take a young, hot 20-something, and then you see the young, hot 70-something. Wow, that's different. That's 50 years. Vince Klingnicht says it will raise prices on housing inventory because you're putting more buyers into the market, so prices are expected to go up. Is that what you're saying, Vince? Hillary Kerchief said, bad, just creating renters who are now required to maintain the home. Ooh, that's the old, y'all remember when, what's his face? Grant Cardone was like, in the future, we will just be a nation of renters. And what he was talking about is people that can never pay off their mortgages. Dusty said, bad, temporarily make mortgages affordable, but we don't have enough homes, so buyers will flood the market and drive prices up. Buyers left the market because they can't afford current payments, so more buyers, prices go up again. Olivier says, why not do 99 years mortgage like the UK? Really? They have a 100-year mortgage in the UK? That's wild. Wild. Matt says not good.
Castle's usually staying the same for a while.
What? You're breaking up real bad. What'd you say?
The castles usually stay in the family for a while, so
that well.
We don't have castles here.
It's true. Those castles are amazing. 100-year mortgage on the castle. Okay. The Babylon Bee took aim and said that banks are actually having people's kids and grandkids sign notes for the 50-year mortgage to insure it. Okay. Let me see. And they said the 30-year mortgage from President Roosevelt, 50-year mortgage from President Trump. All right, so is this good or bad? What are the numbers? So this is what I've seen online. People are like, oh, the 50-year mortgage is terrible. It's going to, it's going to blow up the housing, all that jazz. People pay so much more in interest with a 50-year mortgage, over that time period versus the 30-year. And that is true. The numbers, I did a $300,000 house because that's our average. I also used a 6% interest rate for the 30-year and a 6.5% interest rate for the 50-year because that's kind of about the same difference from a 30-year to 15. I think it's probably going to be half a point over. I don't think it's going to be less than a half a point more than the 30-year mortgage. So on a $300,000 house, the payment on a 30-year mortgage at 6% is $1,798. The payment on a 50-year, 6.5% is $1,691. So it's $107 less. In talking with a lender locally, that $107 adds roughly $16,000 and some change of purchasing power to the buyer. So I would anticipate seeing prices increase because of the additional buying power that a buyer has. But let's look at the total paid over the term. For a 30-year mortgage, matured to 30 years at 6% interest rate, the total paid is $647,514.57. So you buy a $300,000 house today, In 30 years, you would have paid in $647,000, 514. In the 50-year note, at 6.5%, you buy a $300,000 home today. The total paid would be $1,014,690.40. That's right. That's $714,000 of interest, 715 for easy math, versus $348,000 of interest. You're doubling the interest paid. The extra interest is $367,000. You could buy another $300,000 house and not pay it off for 30 years and to get that interest on the other $300,000. What? Isn't that wild, y'all? So, let's see. Oh, I don't like that song. Let's do this song instead. So what I had to do, this is an interesting chart. Let me share this. Share the screen. All right. So the chart, this is based on that $300,000 loan. This is the, I had ChatGPT do this math for me. We know that people don't keep their home 50 years. In most cases, people don't keep their home 30 years. So some say comparing the interest paid over those time periods, it's a false comparison because nobody keeps their home for that long. Okay. So if it's a false comparison, move me to Bay Area. It says 2 thumbs down. It's bad. Kimberly says neutral. I think you should try a 40-year first. That's a good compromise, Kimberly. A 40-year note. We need to build up more homes, loosen up and speed up permitting. Yes. Move me to Bay Area. There's 100% right. Okay. I'm getting to all of your comment. Like I said, 2 thumbs down. Okay, then bad. All right, but let's look. Most people sell their home in 5 years to 15 years. Actually, the average is closer to 15 to 18, but let's just say most of the people that we deal with in our lifetimes are going to be selling 5, 10, 15 years. So here's the monthly principals and interest. The interest paid, the principal paid, and the remaining balance. So on the interest paid, well, let's just look at the remaining balance. It's easier. After 5 years, a 30-year fixed mortgage at 6%, you pay $300,000, you have $279,000 left. Now, this is the most eye-opening comparison. 5 years, 50-year mortgage, 6.5%, you have $295,000. So you've paid off less than $5,000 in 5 years with a 50-year note. All right. So where is it equal to the 5 years? If a lot of people sell in 5 years, we see that kind of number a lot. $300,000 house, 6% interest. They have $279,000. You could sell at that price, pay fees and everything, and move into a new house. That's fine. Where's this number the same? On the 50-year chart. If you look at the 15 years, you equal almost, it's actually about $900 off, but you almost equal what the 50-year chart is in 15 years. So the 15-year chart in 15 years, remaining balance, equals roughly the 5-year chart in 30 years. Are we tracking? So after 5 years on the 30-year note, $279,000. After 15 years on a 50-year note, $279,000. So do you still think it's a good thing or a bad thing? Does it encourage homeownership and allow more people to live in a house? Yeah. Is that good if they're not building equity at a rate faster than the 30-year note? Is it okay to be in a house building equity at this snail's pace of roughly $5,000 in a 5-year period? $1,000 a year. What say you? Dusty Martin says, this is why investment banker great uncle said there's interest interest is for suckers. Yeah. Vince said an average dwelling has a 60-year economic life. That's interesting. You can't pass the property through generations. I guess you'd be passing the loan too, huh? 100-year mortgage is called a generational mortgage, yes. China and Japan have a 100-year mortgage too. I didn't know that. All right, let me go to Instagram. Lydia Gable said, wouldn't the same formula be true for a 15-year? I feel like people buy to monthly payments. Yeah. So, but on the monthly payment, they're only saving $100. So if somebody is looking at a property and they're saying, well, I save $100 a month, that's $1,200 a year. But what they give up is a tremendous amount of equity savings. The $100 a month, I mean, this is at $300,000. I guess if it's $600,000, maybe it's double. Let's do that. Let's get to the pairs. Because what are your averages? Some of you guys are in averages for 600. So do the same comparison for a 600K property. All right. We'll see if it can do that live. Kimberly said, well, Brooks, what's up, Brooks? Brooks.eastbay. Brooks Landry says, but it's just an option like a 15-year arm and any of the arms. Yeah, but it is one that you're not making anything. Move Me to Bayer says, forget equity, let them write off interest. Okay. Still more stable to own for most. Oops, I just dropped Clubhouse. Sorry, guys. Is it though? I mean, I always felt like ownership was good because of the equity you built over time. I am having trouble seeing a good quality of home ownership if you're not actually building equity in it. Equity is not the only reason to own. Quality of life is vastly. It can be different. There's some amazing rentals out there. It can be different, but I mean, like what? You get to paint your walls and take care of your own AC issue? I don't know. Here, lack of affordability and low inventory is a huge problem. I think that's the bigger issue, is that the affordability and inventory is the bigger issue. I personally have trouble convincing someone to buy a house with a 40-year mortgage. I mean, the bank is making all the money here. And people reborrow against their house and never get out of mortgage. That's true. Once people have equity, a lot of times they reborrow. All right, let's see what the 600,000, same comparison, 6%, 30 years, 6.5%, 50 year. After 5 years, 558. Oh, look, it's almost the same. After 15 years, 559 is the balance. After 5 years on the 600K loan, 590. So they've got $10,000 of equity. This is roughly, it's actually 11,400, but it's 9,400. But we're going to call it 10,000. It's the number's right here. 9,350. Duh, Ray. After 5 years on a 30-year note, 558. They've paid off $41,000. So 41,000 versus 9. And the payment differential is 3,597 versus 3,382. So the payment differential is $200. And after a 5-year period, the equity differential is $30,000. I can't look at this chart and say, yeah, I get a 50-year note. There's no way. You would be better off buying a smaller house with a 30-year fixed that $100 in purchasing power, in this case, a $200 in purchasing power, taking a smaller house and then having that for a shorter period of time, just living there for 5 years, having a huge equity stash, and then moving that equity over into another home. That would be
Or you could take a variable. 3, 2, 1
variable. Yeah, that's what. So Brooks Landry in the comments, he's talking about arms and stuff like that. Do you know that kids do a grade level higher in people who own versus rent? Really? Interesting. But would they do that if their parents aren't, I mean, would they still be a grade level higher if their parents can't do the math between a 50 year and a 30 year? Brooke says, I think we would get more bang for our buck by adjusting regulations when it comes to, yes, I agree. When it comes to builders capping companies like BlackRock and their investment home portfolio. So investment home portfolios, I think it's hovering around 15% right now. Investors percent of home purchases. Someone said 30% the other day, and I haven't seen a number that high ever. The last time I looked, it was 15%. In Q2, investors accounted for 10.8% of all home purchases. That's up slightly over 10.7. It's just below the peak. The peak was in 2022 of 12.1. So I don't think it's investors that are really the problem in most cases. It's 10% of the housing market. It's just not, I don't think it's what we think it is. Let's see. Homeowner kids do better because they have more stable home financial. I guess they're going to have to be stable, Kimberly Mann, if the parents got to be there for 50 years. Over worry having to move kids. So I mean, my parents rented a long time and I had a stable home life, and they rented one spot for years and years and years. And then I think we moved like 3 times my entire 12 years of high school education. So I guess we moved once during that time period. Then we moved back. So I don't know, Kimberly. I think it's more the choice of the parents. I think what we're seeing is a correlation without causation type of situation where there's a lot of people that rent because of the choices they've made in life haven't set them up to be homeowners, and those choices are impacting their family apart from whether they're renting or in a home. The renting or in a home is separate from the lifestyle choices they're making that are causing them to not be able to rent, not be able to be in a home. So I think the stats are skewed because to own a home, you have to have some kind of responsibility to save for down payments, to be making other payments and installments on time, to have good credit. So those things are the activity that would lead to home ownership. And if you're not doing those responsible things, you will rent. And also, if you're not doing those responsible things, you're probably not taking care of your kid like you should. So I don't think it's home ownership that makes someone a better parent or that makes their kids smarter. I think it's the activities that person is doing that makes them a good parent and, makes their kids better students, that also enables them to purchase a home. Seabrooks. But rentals aren't as stable. I don't know. I think I was in a rent. Like I said, my parents didn't own a property until I graduated high school, or actually I was in college, and I was pretty stable. Causation, correlation, misnomer. Parents who bought are usually more educated and therefore educate their kids. Renters are not and do not. It's kind of what I'm saying too. Dusty says, I feel nauseated thinking about somebody taking out these loans. They'll be stuck in it forever with almost no equity. Oh, Matt, good point, Matt. Matt said, it's not like you can't refi it. You're 30. Yeah, true. Take out those $3 of equity you have after 30 years. He goes on to say, but that's not the American way. Buy things to impress people you don't know. Yeah, that's what we should be doing. Porsches, right?
Well, yeah, something like that.
He said, Hillary Kerchief says, we don't have enough homes as it is. This would increase the buyer demand up front if they can't do the math. Then taking more product off the market because these people have to stay in their homes longer because they can't afford to move. Yeah. If they stay for the full loan, then no one would sell because their mortgage due to inflation would be ridiculously low. If so, I mean, would a home that is, you know, 300,000 today in 50 years be worth $1 million? Because that's what they've paid into it. That's kind of, usually you would see like what you've paid into it and then say, well, I know we've paid in that much money into it, but really it's worth more than that. I don't think you could say that for a 50-year note. I think there's something that goes off balance, off kilter there. All right, so there it is. We'll see what happens. I think if it does become a product, I'm not going to encourage anyone to do it. I'm just going to show them this chart. I'm going to say, if you do it, here are the numbers that you should be aware of. And so, you know, don't call me in 5 years and expect to call to sell without bringing money to the table, because you won't bring money to the table. That's it. You got no equity after 5 years. 10 years, you got a shot. 15 years, more so. Sure. All right. I'm also assuming in this, I guess I am assuming a sell price that reflects similar to what they bought it for. But I should note that the reason why I'm assuming that is because the huge inflation that we've had over these last few years, I think it's going to slow down and even maybe flatten out a bit. Home price gain slow, quote unquote. So I would anticipate a 1 to 2 to maybe 3% increase over the next 5 years or so. I'm not going to anticipate a huge annual appreciation number. All right, so some other news we got to roll through pretty quick. Mortgage giants are very close to accepting a new FICO score. So currently they're using the FICO, 4? Vantage Score 4 and FICO. Let's see. Now they're using, okay, here it is. The FHFA have been working for several years on plans to replace the FICO Classic, is what it's called, for nearly 3 decades, with Vantage Score 4.0 and FICO Score 10T, which consider tendered credit data and additional inputs such as rent, utility, and telecom payments. So if you are making payments of stuff on time, you should get credit for it. Even if maybe you don't love debt and you don't have a card, maybe you paid cash for your car, so you don't have an installment. How are you going to build your credit? Well, now you can use additional inputs such as rent, utility, and telecom payments. I think that's great. I don't love it for people that have errors on installments. And so I'd love any feedback from a lender out there. I don't want to see the additional helps curing major issues, like just because you paid your rent and utilities and telecom payments on time, but you went you went upside down on your car. That seems like it shouldn't cure it. Kimberly, I just saw your Instagram on this. Are you basing this off of you being a stable person? Right? Yes, I'm basing it off my own lived experience. That's funny. Okay, yeah. So I like adding some stuff to the FICO score, but I don't want to see these additional items cure a big problem with an installment issue, because I think that's a big deal. But for people that don't have an installment at all, that paid cash for stuff and don't love debt, I love this idea, because you should get some credit for rent and utility and telecom payments. So I think it's a good deal. So drop in the comments if you're a lender. What do you think of it? Veterans have been priced out, left behind by the housing market. This came out on Veterans Day. There are a couple of Veterans Day articles that were definitely clickbaity. Typical veteran household can afford 21.8% of the home listings with a VA loan, which requires no down payment, no private mortgage insurance. However, veteran households using conventional loans can afford a greater share of the housing market at 26.5%. Slight improvement from 2023. All right, let's look at the next article about veterans. Affordability improved slightly for veteran home buyers, but most homes are still out of reach. I feel like that's for everybody, not just a veteran. Nationwide, 1 in 5 home listings are affordable to the typical U.S. military veteran using a VA loan. Affordability has improved slightly over the last 2 years. Just 20.2% of listings were affordable to the typical veteran using VA loan in 2023. Okay. It is down a lot. It was at this highest. Share of listings affordable to veterans with a conventional loan was 68% in 2012. Share of listings affordable to non-veterans with a conventional loan was 63%. And share of listings available to veterans with a VA loan in 2012 was 53%. Look at this now. It's all the way down to 22%. But the share of listings affordable to non-veterans with a conventional loan is at 23%. So it's tracking with, it's just tracking with what's normal. So I feel like this is non-news that they just waited to put this out there until Veterans Day to get some clicks. I mean, let's call it what it is. All right.
Yeah.
Yeah. New data shows a
So some of you
slash and
guys
a wait
do
for
this on a
homeownership.
daily basis. Yeah.
Yeah, I mean that's what they do. This one also came out on Broke Agent Media on Veterans Day. Data shows VA loans slash the wait for homeownership by 4 years. VA loans can cut the wait by 4.4 years. 74% of first-time VA loan users put zero down versus 12% median down for first-time conventional. On a typical $430,000 home, conventional buyer would need about $51,600 up front. That VA buyer would not. That's a 15% savings rate, translates to 4.4 years of waiting. So there you go. Go into the military so you can buy a home 4.4 years sooner than your average Joe. Your GI Joe can buy in 4.4 years versus the average Joe. Is that good? Is that good military humor, Andy? Average Joe versus GI Joe. That more people should use that comparison. Actually, that's pretty good. Average Joe versus GI Joe. I'm going to put that in the marketing.
That is good.
Yeah.
I like that.
I'm going to do that on a landing page.
And here's the thing too. Just part of that lower average is active duty after 90 days of being in can be used for VA homeowner. 90 days.
It's true.
Now, are they making a ton? No, but if they're in an area that has the price point for them to purchase, sure, they can do it.
Military members, veterans make up a slightly higher share of mortgaged home buyers than last year as buyers market persists. So they're buying more, Andy.
Yeah,
Average
they
Joe
are.
versus GI Joe.
And we're getting, it doesn't look so bad at all, but we're still getting more information out there. Most veterans don't realize that they can use their home loan.
There you go. All right. We have 3 or 4 more articles. I got to roll through these pretty quick. Flood prone America is seeing more people move out than in for the first time since 2019. Well, we know why. It's because insurance rates are crazy. Insurance rates are crazy high on the flood prone America. And you changed what year? What year did FEMA change the flood maps? You remember when FEMA changed the flood maps? Backward looking flood maps. They were changed when the implementation was talked about in 2017, and flood map program needs reform. What year? Notes to Congress. I want to say it was around that same time because we covered it on the show. Maybe it was in 2019 or 2020. So look, ever since then, now, flood-prone America is seeing more people move out. Of course. Because you increase the cost on everyone that was just kind of normal out in the boonies. And now they're like, well, I can't move in that area now because I can't afford the insurance. I say boonies. They're looking at Miami-Dade, Harris County, Kings County, Hudson County, Jefferson Parish, New Orleans Parish, Pinella County, North Fork City, Virginia, Cameron County, Fairbanks, North Starborough, Alaska. I mean, it just makes sense. You changed how it's calculated, so You're going to have more people now in floodplains. You change the maps. Yeah. It's not another non-news story. Pending home sales barely budge as buyers stay cautious despite lower mortgage. Well, only recently have we had the lower mortgage rate. So pending home sales ticked up 0.7%. Typical homes sold in October went under contract in 48 days. It's the longest span for a month since 2019. Home sales are slow despite declining mortgages. The payment is only up 2.1% from a year ago. That's interesting. What's the year over year change? Year over year. Google searches for homes for sale is up 20% year over year. Touring activity at this time last year was down 4% from the start of 2024. Now is up 7% from the start. And pending sales year over year. Oh, year over year was 0.7%. Okay. I was thinking it was week to week. Okay. Only 28% of every 100 homes. Only 28 of every 1,000 homes. I'm sorry. That's 2.8%. Changed hands this year. It's the lowest turnover in decades. That's wild. U.S. home turnover at the lowest rate in decades. Wait, those numbers don't make sense. It says 27.7. Oh, of the 1,000. I was thinking that was a percent. Okay. Yeah, so 2.7%, 2.8% of U.S. homes changed hands. 38% fewer homes sold this year than during the pandemic peak. Are you guys feeling that? Move Me to Bay Area says California has huge issue with fire insurance. Buyers may not qualify for a loan if they don't have a policy secured. But it's okay. Even if they were to build in a fire area, they wouldn't be able to rebuild for years and years and years and years and years. So why would somebody want to do that? What's up, skate agent? Move Me to Tennessee's here too. What's up, Marie? Dusty Martin says, so we're back to normal from Pandy. Yeah, it does seem like we're back to normal. I've seen this movie before. It's kind of scary. It's not that. It's not 2006. More homes are being listed in 2025 than the past 2 years. Look at that. That is a pretty big increase. We're at 38.7 per 1,000, so 3.8% versus 3.5% in 2023. But it used to be, wow. Y'all remember the days? I remember these days. 2015, 54.4 per 1,000, so 5.4%. Why do they do the numbers? It's crazy. 5.4%. I can remember in 2015, 2016, 2017, 18, 19, it was over 50 homes per 1,000 were listed. How many of you had the Saturday marathon home showings where some people were just like, no, I want to see it all. And when they said that, sometimes you just had to show them all. And I remember one day, my record was 36 homes showed in one day. 36, that was the record. And then the following week, someone else went with me and they were like, oh, we saw 23 homes today. Is that a record? I'm like, nope. And they're like, what? That was 2 weeks back to back because there was so much inventory. And we eliminated tons of inventory that they, were slightly out of the area, out of the price range, or didn't have the bedrooms, whatever it was. We eliminated tons, and we still had tons of inventory on the market to choose from. I can remember those days. Now it's 3.8. So 38 homes of 1,000. It's going up. That's not what it was. Falling American home prices leave nearly 1 million Americans underwater. While negative equity rates remain low in most places, markets showing signs of concern due to the Gulf Coast in Florida, Austin, Texas. ICE Mortgage Technology Expert reports. That's got to be a rough name right now. Just saying. Falling prices in many markets have left nearly 1 million people underwater with their mortgages, and lenders in initiated foreclosure proceedings on 103,000 homes in the third quarter, a 23% jump from a year ago. Well, when was the moratorium over for a lot of these people? I remember that. The foreburned thing, which I posted the other day on my Instagram. If you missed it, foreburned was, those were the times. We need more foreclosures in the marketplace to make it normal. It is not a normal marketplace right now because there are so few foreclosures, so few properties that are distressed, or sellers that are distressed. Nationwide, 870,000 homeowners with mortgages are underwater, meaning they owe more than their house is worth. Homeowners who are underwater are more likely to end up in foreclosure. At 1.6%, the U.S. negative equity rate is the highest it's been in 3 years. Of course, it's the highest it's been in 3 years because you could sell your home for way above. Remember this? We were talking about this. People are looking for foreclosure deals during the pandemic. We're like, you're not going to find it. People are just going to sell their house way above asking. Thanks to the run-up in home prices during the pandemic, the negative equity rate has been running well below historical average. Where borrowers are underwater, 2.5% in Arkansas. The biggest markets, Florida, Texas. Very low over in California. Look at you guys. I am looking for a 2019 number to see if they give it to us. Okay. VA loans driving foreclosure growth. In 2015, wow, look at that. You just had a huge percentage overall. There's way more people versus now. Although foreclosure sales remain historic lows, the 21,000 foreclosure sales tallied in Q3 represented about half of the 2019 levels. More FHA loans that are 90 or more days late are expected to end up in foreclosure this fall. So we'll see what happens. I mean, I think it's normal. You got to have foreclosures because you have people that aren't responsible and some don't make payments. Some are responsible and just in bad spots. Okay, I get it. But it's just part of the marketplace to have foreclosures. And when you don't have foreclosures, something weird is happening. And for years we haven't because of the moratorium and the market was odd. So now we're going to have more and that's more normal. I thought this was an interesting 3-bedroom homes reach highest market share since 2011. I thought that was really interesting. 3-bedroom homes have long been the most popular model for new homes, but 4-bedroom homes gained significant market share in the post-recession and post-COVID building markets. I remember when a lot of builders were changing how they build, they were adding that 4th bedroom because so many people wanted a home office and such. Well, now it's kind of back to normal. Less people are looking for that. And then the last article for the day, mortgage demand from homebuyers hits the highest level since September, despite the rising interest rates. That's right, guys. Interest rates did go up. Some of you are like, what? I thought the Fed dropped them. Where you been? We talk about this every week. Mortgage applications to purchase a home rose 6% last week to their strongest pace in September, according to the Mortgage Bankers Association seasonally adjusted index. The volume was 31% higher than the same week a year ago. And we are feeling that too. The number of showings on our properties has increased drastically this week. So this came despite the average contract interest rate for a 30-year fixed mortgage conforming loan balance of $860,500 or less increased to 6.3%. 6.34% from 6.31%. I remember just 2 weeks ago it was 6.19%. So the rate has gone up. Mortgage rates haven't moved much this week yet, given the bond market was closed on Veterans Day. So a little bit of wait and see. I think it'll go back down a little bit because the Fed said that there was going to be one more rate drop this year. But it's kind of a wait and see there. Well, guys,
we are on a downward trend. Let's look at this positively. We are
correct.
On a downward trend.
Correct. Yeah, if you drew a trend line from the what was it? I mean, it was crazy. It was crazy low. Then it went up and up and up to what, 7 and 8%. So now we're on a trend downward for sure. So's inflation. So hopefully that sticks.
Yeah, that's going to help out a whole bunch. So
Well, thanks y'all for joining me today. That's all I've got. So please be sure to go find me on the Instagrams. My username is Ray Zorback, RayZorback. So find me there. If you're wondering how this guy like Andy just started talking during the show, that's because he's on Clubhouse. So you can always find our Clubhouse. Find me on Clubhouse. Christina Smallhorn, you're a little late. She says, I missed it. Dang. Luckily, Christina, there's a replay. And in about an hour and a half, all of the articles and everything we talked about will be timestamped below in the description. So you can just click those timestamps and see what we covered. It was a rousing discussion about Zillow and the 50-year mortgage. So hopefully you'll go watch the replay. And thanks to all the podcast listeners that downloaded this and are still like cleaning your house, doing chores, doing paperwork. I get a lot of comments of what you guys are doing while you listen to the audio. So I really appreciate that. And I will see y'all next week. Bye, everybody.